to the Money Market. I'm your host, Paula Joy. With me today is Mr. Ken Walker. Ken Walker works for MCM Capital. Ken, welcome to the show.
Thank you so much, Paul. This is quite the honor, and I'm excited to be here.
So, Ken, I got a lot of lenders that come to me, especially now. I just came from the California Mortgage Expo, right? It was there 2 days ago. Yeah, I was there 2 days ago.
Unfortunately, we couldn't make it to that one. We were on the East Coast at the same time. But
that's all good.
Looking forward to coming out there soon.
Right. So a lot of people are talking about non-QM. It's the hardest thing nowadays. And I see a lot of those companies. I interviewed a lot of them. I interviewed NewFi, Angel Oak, I interviewed Splow, I interviewed all kinds of people. Okay. So I took my camera there with my camera woman, and then we took this stuff. But everybody's talking about non-QM. A lot of lenders, my guests are mostly real estate agents, right? They're real estate agents, real estate brokers. And I want to tell them, okay, who is best at what? So today I want to hear from you, okay, what do you guys do? What's MCM?
Okay. Well, I mean, we are, we're not a broker. We are a lender. So you're working directly with the company that's going to make the decisions. We're fully delegated with all of our investors in the products that we do. Okay. So we make the end decisions. We clear the conditions. The loan, closes in the name of MCM. So when the brokers come to us, they know that, they're dealing with the lender who's going to be the one making the decisions. Okay.
Yes.
I mean, that is by far one of the biggest things that we do in terms of being able to provide good service levels to our brokers, and hence to their referral sources or their borrowers. So, as far as the products go, for any borrower that's self-employed, okay, for the most part, the tax returns that they show to the IRS don't typically reflect the true income that they're making with their self-employment. So we're able to kind of structure these deals in a different way, utilizing things like bank statements. Can be either personal or business bank statements. Okay, and we really only need 12 months worth. Okay, 24 is okay, we can do that too, but as it's been my experience, 12 months tends to be easier for borrowers easier pill for them to absorb. There's really not a whole lot of difference in the structure or the pricing on that. So I always try to go path of least resistance. What's going to be the easiest way to get the deal done? Okay. Another way that I've really found with the self-employed borrowers to get those deals done is that we will just take a P&L prepared by either, whoever does their taxes. So if it's a CPA or if it's an enrolled agent at the IRS, because with the bank statements, it's been my experience that there's a lot of moving parts to bank statements. There's deposits, there's withdrawals, there's transfers, there's things like that. Okay, that can tend to get a little confusing, especially if we're talking about multiple pages over multiple months. Pretty good chance that the underwriters are going to miss something, or we're going to miss something. So it's better if we get the P&L, and then that way we have a number. That number is right there. We all know it. And then we just need a bank statement or two to just show that, hey, the deposits are somewhat commensurate with that bottom line number, and boom, the deal moves on. And hence we were able to get the deals done a lot easier. As I said, Paul, I always like to try to get, the path of least resistance. I've been doing this stuff for a long time.
Right.
So I understand how, what it takes to get these types of deals done. So, and that's what I said with the self-employed borrowers. Now, of course, there's lots of other options out there. Maybe you have a borrower who's a foreign national, has a property, resides in Canada or Mexico or somewhere else, but has some property in the U.S. that he's looking to either purchase or get financing on that's not his primary residence. Do those deals all the time. They're easy to get done, just some basic documentation, and boom, we can move with that. And of course, a lot of property investors tend to fall into the non-QM space. Why? Once we get back to the tax returns, that once you start taking all the deductions that property investors take on their investment properties, all of a sudden we don't have a true accurate picture as to what the true rental income is and what the cash flow is, and all of a sudden they don't qualify going normal through normal procedures. So we just do what they call a DSCR, debt service coverage ratio. Okay. Right. And we also have another product that not a lot of other companies that you mentioned right there have, and that is a true no ratio product, where we don't even care about the ratio. Mm-hmm. Okay. Just strictly LTV and FICO score determines it. Now, this is on investor properties as well.
Yes.
We can do those up to 70%. So, the borrowers don't have to put like 50, 60% down. We can do those at 70% LTV. So that's becoming a really, really popular loan as well. Combined with that, we actually go 100% gift in the investor space as well. So if maybe, they're getting a gift from, mom or dad or, some other type of, relative, and we can document all that. Literally 100% of the down payment and closing costs can come from a gift.
For
So it's really good for like first time investors, especially,
Okay, so that's for investor programs, right? So
Correct.
how about for owner occupied properties using bank statements? Would you also allow, a gift?
Now you do allow gift that will require 5% of the borrower's funds, own funds into the deal. Okay. So we're going to, of course, that's going to need to be documented. So it's only talking about 5%. Okay.
Right.
So maximum LTV on these products is 90%. That would depend on FICO score and loan amount and property type and those types of things. Basically the same thing that a lot of the other companies would require as well. But yeah, we can do those, to 90 LTV with a 5% gift. So literally they would only have to put 5% into their own funds into it. So it's a good product, especially for like a first time home buyer.
Let's go back to the DSCR program. So for the DSCR program, I saw that your flyer says you don't require any reserves. Is that correct?
That is correct. Yeah, we have one investor with this space that has no reserve requirements. Now that does require that we the LTV gets reduced on that, so it'd be a max of 70% LTV for that product. That we just juiced that. It used to be 65 was the max on that. Now we're able to do it at 70. So, it's definitely helping get more deals in the door.
That's good. So how are your rates? Are they competitive? I mean, because a lot of
Sure. I mean, we're not talking about agency, 1.5%, 2%, rates here. I mean, these are loans for borrowers that don't qualify for those super, super low rate programs. So, you just need to make sure that loan officers are setting the proper expectation with the borrowers that you're not going to be getting, rates in the 2s or even 3s. Most of these would start somewhere in the low 4s.
Yes.
Depending on what layers of risks there are, could go up. I mean, if it's got plenty of risk associated with it, low FICO score, high LTV, you could be pushing into the 6s.
Right.
But the vast majority you're looking somewhere in the 4s, low 5s. Now, borrowers in that DSCR program, for the most part, they close in LLCs.
Yes.
Or entities as they call it. So as long as they're not as rate sensitive, maybe as say maybe some of the owner occupied borrowers are.
Yes.
So there is and frankly there's more risk associated with those. So the market basically compensates for the additional risk doing it for an investor property.
So generally speaking, also, one question that a lot of people have nowadays is where are the interest rates heading? And I know that the government is not poised to do anything with the interest rates, but what's your take on that?
I mean, and I'm far from a Wall Street expert here. Okay, I just get my rates when they come in every day, and I just make them work.
Okay.
So because in the non-QM space, to be honest with you, rates not always necessarily as much of an issue as it is in the QM space. Okay, So I mean, frankly, if rates go up for the agency, your FHA and your Fannie Mae and all that, when their rates go up, that tends to make our business even better. So we kind of like it when agency rates go up because that means more business for us. There's more fallout coming out of that space and has to go into the non-QM space. So I mean, it's really hard. I mean, I've yet to ever see anything that's given me any kind of true direction as to where interest rates are going to be in the non-QM space. Certainly in the QM space, you look at your treasury indexes for the most part, and that tips you off there. But so far I'm just pretty happy with the way the market has been going, especially for the last year. And hopefully it'll continue.
Okay, cool. Now let's talk about reverse mortgage. So basically, this is another product you guys are selling.
Yeah, it's
I,
probably, as you can
not
see
a
from
lot
my
of people
thing,
are
I mean, it's
selling.
one of
Not a
our,
lot of people are selling them. So tell me a little bit about this. Okay, so the pros and cons and what people think the misconceptions that people have about reverse mortgages.
sure. And there are a lot of misconceptions out there, but a lot of those misconceptions now have been mitigated recently. First of all, FHA changed their guidelines about 4 years ago, I guess, and they scaled back on the LTVs considerably.
Yes,
Okay, so to get one of these, of course, you have to be 62 years of age. Now,
yes,
that would be, the age of the youngest borrower in the household. Now, actually, if someone is under 62, but as long as another borrower is 62, we can still do it. The LTV gets reduced even further, though. But at 62 years of age, your max LTV on the loan is still under 50% at 49.6. Okay.
yes.
The absolute highest LTV you can do a reverse mortgage at is 75 LTV. You need to be 94 years old to get that.
Hmm.
So FHA made a lot of changes. HUD made a lot of changes for that, just, basically to protect seniors.
Yes.
So I think, in essence, it worked out really well. However, these loans are becoming more and more popular, especially as baby boomers continue to grow in age. Myself, I'm only a couple years away from qualifying for one of them myself.
Okay.
So, and it's part of my financial plan, to get rid of the mortgage and not have to worry about a mortgage payment anymore. So, the important thing is that when you're selling those, the first thing, the expectation you need to set is they need to know that even though they'll no longer have to make a mortgage payment, okay, they still have to pay their taxes and their insurance.
Right.
The only way one of these loans can go into default is if the taxes don't get paid. So just need to make sure. And we have ways, we have a methodology that we put when we're underwriting these loans to make sure that we feel comfortable that they're going to be able to handle the taxes and the insurance. Reverse mortgages are a little different than the forward side from the underwriting standpoint in that there are no, minimum FICO scores or maximum DTIs or anything along those lines. Someone has a sub 500 FICO score with minimal income, it's still a potential loan that you can get done.
Right.
The underwriters in this space will look at the overall capacity and willingness to repay for the borrower. So so just because maybe they have bad credit or maybe you're worried about their income, don't hesitate presenting that loan to us because we have lots of ways to make those deals get done. But they're becoming an increasingly popular way for seniors to be able to kind of navigate their finances, in their older years. Another popular loan with reverses, and one that we've got a bunch of that we're doing right now, are what they call HECMs for purchase.
Okay.
So a senior, maybe, they've been in the house for 30 years. They raised their family. The house is free and clear, or, very small mortgage on it. And, we'll just use round numbers. It's worth $500,000. Okay.
Mm-hmm.
And they're looking to downsize. They're looking to get into a smaller property, but, they're also going to be, retiring, and they're only got Social Security coming in. So they have to really, really watch their finances. So there's a way for them to purchase maybe the downsized property. Maybe let's just call it a $300,000 house as opposed to, the $500,000 nice single family. They're moving into a $300,000 55 and over community PUD. Okay. Something, townhouse, those types of things. Okay. So they would be able to literally put only $150,000 of the $500K that they're going to net from the selling of their house into the purchase of their new property, do a reverse mortgage for the other 150. They no longer have to worry about a mortgage payment. Yes, they still got to pay the taxes and the insurance, but instead of, spending that additional $150,000 on a house, they now have that to be able to invest with, or take a trip with, or, invest, do other things with. So it gives them a lot more financial flexibility as, as a senior borrower. So it's a really, really popular loan.
And I think that should be very important to real estate agents, okay, who are my audience, basically.
Absolutely. Real estate agents need to understand that.
Right.
And a lot of them still have the misconception that a reverse mortgage is bad. It's just a bad thing. When I think I just teed it up, what a benefit that is to a potential senior borrower.
Okay, so let's take it down here to San Francisco Bay Area, where you have an average property is $1.2 million, $1.5 million, whatever. Okay, so maybe they own that property free and clear, right? And now they don't need that big property. They can downsize. Okay,
Downsize.
maybe they owe $500,000 or whatever on that property. They're going to buy another property that is like okay, maybe it's 500,000, 700,000,
Okay.
a condo. Okay, maybe a condo for seniors and stuff. How would you structure that kind of deal?
Well, as long as they're willing to, be put half of the purchase price down, because in essence, that's about where the average LTV falls
Okay.
for just about anybody in their 60s.
Yes.
Okay, then you would want to just do what I just said there. Just take whatever the portion of it is that's half the purchase price,
Yes.
put that down, do a reverse mortgage on the other half, and they're done. And then they the $1.2 million house that they just sold, they're still going to be able to net out
Quite a bit.
almost $800,000 of proceeds from
Okay.
that to be able to go and do invest in the market or take a
Yes.
trip or buy the boat that they always wanted or whatever they want to do with it.
Yeah, I
Okay,
think that's very
so
important. That's very important. Okay, again, I think that's one thing. If we don't say anything else, but say this part, I think that's very, very important. Okay, somebody sells their house, okay, they net $800,000, okay, and they're going to buy another house that is smaller, downsizing, okay, they only put 50%, okay, of whatever that price is, the purchase price is, and
Correct.
that's it, and they don't have to pay a mortgage on that new property.
they won't have to pay a mortgage on if they choose not to. Now
Yeah,
they have the ability to make the payments if they want. What a lot of borrowers in that situation will do is just to protect their equity interest, will
Yes.
make an interest-only payment every month.
Yes,
So that because interest does accrue on these loans. Now the rates are extremely low right
oh, yes,
now.
yes.
Okay. I mean, we're talking most likely in the low twos, kind of where they're at right now.
And these rates are basically, I mean, the term is 30 years, just like any other
It is
loan.
Yeah, it's amortized over 30 years. Okay. It is an adjustable rate loan. So, the potential for adjustment happens and it is a monthly adjustable. However, the index about a little over a year ago had moved from the LIBOR index to
Yes.
what they call the CMT index, okay, or the constant maturity treasury index.
Okay.
Okay. So, and
That's
like
pretty
right now
stable.
today,
That's very stable.
that index right now today is 9 basis points. Okay.
Okay. Okay.
So
What does that mean exactly?
if you set the margin at 2,
Yes.
okay, and their first payment would be due at 2.09%.
Hmm.
And then it could adjust monthly, but it's one of the more stable indexes and certainly, a super low index, which is why HUD made the change to it. So it's, it's just been a really, really good way for seniors to be able to take advantage of what we're talking about here, which is, getting in, not having to make a mortgage payment, or if they choose to make a mortgage payment, it's going to be a small one. So,
Wow. Okay, cool. That's great. Is there anything? Okay, well, no, let's talk about the highlight of it. You've been in this mortgage industry for a long time. What's the
yeah, look at
highlight?
that. What's that tell you, right? So
No, no, I got nothing.
if I had the hairline like yours, Paul, then, I've been doing it for a long, long time. So as a lot of folks have in this industry, I mean, but it's good to see that there is some new blood. I was just at a conference last week in New Jersey and saw a lot of young talent there. So I think the industry's in good shape. But anyway, what were you saying?
What's the turn time for you for QM loans and these reverse mortgages?
Well, that's a loaded question right
Yes.
now.
Yes.
And as I'm sure anybody in the mortgage business right now can attest to, our friends Dodd and Frank back in 2008, I think they meant well when they
Yeah.
created the HVCC, this appraiser independence thing.
Right.
However,
right.
it's really starting to rear its ugly head right now.
I understand.
So appraisers are taking forever simply
Yes.
because they're overloaded with the business and there's less and less appraisers out there to do
Yes.
the business. So appraiser turn times are really what's going to dictate what the turn times are.
Mhm.
In a perfect world, 30 days is still attainable. I'm trying to tee it up right now at 45,
Mhm.
simply because appraisals are taking forever. So that's kind of where we're at right now. And that's both non-QM and reverse mortgages.
Okay,
So
cool.
I'd say 45 days is about an average right now, unfortunately.
Right. So I think the question I was going to ask is like, what has been the highlight of your career, as a mortgage?
Besides being on this show right now?
Yeah.
No, I mean, the highlight, it's hard for me to really pinpoint a certain thing. I think just all the relationships that I've been able to build over the last 30 something years doing this stuff.
Yes.
It's fun. Like I just went to a conference last week in New Jersey and I saw some people I haven't seen for, 20 years or so. So it was
Yes.
great to see a lot of folks again. So I'd say the highlight for me is definitely that, all the friendships, the relationships that I've built. I always, say that, everybody goes to work every day trying to do the best job that they can in this business. I show up every day with my, my uniform on, ready to go to war. The mortgage business is the great whirlpool, Paul. And basically, as you've seen, when you get in it, it's a great business to be in.
Yes.
So you don't want to leave it. So it kind of sucks you in. You're going to go around and around and around, and you're going to touch everybody in it, most likely at least one time.
Yes.
So I try to maximize every conversation I have, every meeting that I have, every relationship that I'm able to cultivate, so that, knowing that someday along the line, I'm going to need to call on you for a reference or, I'm going to have to be able to refer some business to you or something along those lines. So it's definitely, the highlight for me has been that, just all the great relationships that I've been able to cultivate over, the last 30 years or so.
Thanks, Ken. It's been wonderful having you on the show today. Right?
Well, listen, I really appreciate your time. Good luck to you. Good luck to everyone out there. Definitely, definitely keep MCM in mind for your financing. If anybody needs to get a hold of me, Paul has my contact information. I would love to see what we could do for you. Okay.
Awesome. And so thank you so much for watching too. And if you have any non-QM loans, that means basically bank statements, you have self-employed people who are looking to fund properties or to buy properties, whether they are investment properties or they are personal residences. Yes, we got those people for you. We got the programs for you. 90% financing, right, with 10% down, right, for self-employed people with bank statements. And if your guy is an investor, right, and they're looking to buy investment properties, we got those programs for you, even the ones without any what they call debt service coverage ratio, no ratio at all. I mean, we got that. You heard Ken say
do
that.
Both no ratio or, we can go off the debt service, which is basically how the property cash flows.
Right.
We can even do it in a negative cash flow. So it may not even be cash flowing positive. We can still get those deals done.
Yeah, and of course, for those of you who are old enough, like 62, or you as an agent, you know some clients who are 62 years old and they want to downsize. Okay, you heard it today. Ken can help those clients as well. So call me anytime and I'll be here for you. Thank you so much for watching. This is Paul LaJoy, your mortgage consultant for life.